Hi everyone, this is the OCL week tutorial topic for money and the banking system. Now before you go through this tutorial with me, look through the questions, see whether you can do them. If you need, go and access the money and the banking system tab on LMS. You can find the online lecture there. That can help you to recap some of the points that we have gone through in lecture last week. Okay. Now for question 1, we want to look at whether the examples are money or not. Now, what is money is given by our M definition of money. Okay, you can find it in your notes. So let's take a look at the first example. Now, current account. Now, what is current account? Now, current account is an account that you can write checks from. Okay, that is a common banking product in all the banks. Now, is this considered as money? If you look at the chart on the M system in your notes, this is money, and it is listed under M1. Now, M1 consists of your currency in active circulation and your demand deposits. Now, demand deposits and current account, same thing. All right. Demand deposits and current account are accounts that you can write checks from. Okay, so the account that finance check writing are usually considered as money and listed under M1. Now for B, we have another product, and this is called time deposit. Now what's a time deposit? Now if you look at under the M system classification of money, you don't find time deposit there. Now time deposit is a relatively new name for an old product which we call fixed deposits. All right. Now if you take a look at your M classification of money, M system classification of money, you see that fixed deposit, all right, is classified under M2. All right, it's counted as money, as one of the quasi money, all right, under M2. So time deposit is a newer name for fixed deposit, whereby people keep money with the bank for a fixed period of time in return for higher interest. Okay, so that is a time deposit. It's money classified under M2. Now, how about a check for part C? Now, a check is not money. It is usually known as an instrument of payment. Now, this is where it gets a little bit tricky. The account, that means the demand deposits and current accounts that finance check writing, the account itself is counted as money under M2. But the check itself is only an instrument. Okay, it is generally not regarded as money, just an instrument of payment. Okay, so the check is not money, but the account that writes the check is considered as money. All right, get that clear. Now the next example we have is demand deposits or checkable deposits. That's the same thing as current account. It is regarded as money under M1. Current account and demand deposits, same thing. Now your cash card, debit card, Nets card, whatever cards that you have, like your checks, they are not money. Okay, they are only instruments of payment. All right, they carry a certain value in them, but they're financed by somewhere else. Okay, so they are usually not regarded as money. They are only instruments of payment, so they are not money. Okay. Now for the next question, you see all the components inside the M classification of money is here. All right, you can take a look. Currency in active circulation, demand deposits, and then you have your fixed D and your NCDs, and then other accounts and deposits. And last of all, you have your net deposits with financial companies. Okay, and the amounts are given here. Now let's revise. Okay, M1, M2, and M3. All right, these are the three levels inside the M system classification of money. M1, okay, you follow your notes. M1 consists of the first two items, yeah, currency in active circulation and demand deposits. We have already mentioned in the lecture, okay, that M1 is closest to our daily usage. Okay, we write checks, demand deposits, or current account, and we use this currency in active circulation, our dollars and coins that we have. Okay, so M1 consists of the first two items. M2 consists of M1 plus the next two items. That means all the accounts and deposits are here. Okay, these are the additional items in M2. So M2 consists of the first four items. Okay, M3, the most general one, consists of all the items, and this net deposits with finance companies is additional item in M3. Okay, and the percentage change given to you, okay, you can tell in the 10 over years, okay, between 1999 and 2012, these are the amounts that are circulating, okay, in the Singapore economy for each individual item. Now you can tell from the percentage change, you see largely an increase except for net deposits with financial companies went down by 10.1%. Okay, but you see the general trend is all these money components are going up, and you can tell this demand deposits is going up very, very fast. Okay, it went up by almost 5 times, all right, by 477%. Okay, now let's use the figures and calculate M1, M2, and M3. So M1, the first two, M2, the first four, M3, everything. Okay, and then we take a look at the percentage change. We want to derive some meaning, okay, out of these numbers. All right, so after we look at the numbers, we will answer the questions below. Now, so we've got the numbers in, okay, M1, M2, and M3. M3 is always the largest number because all the components are in there, okay. M1 is always the smallest because it's the most narrow definition. Again, you see the percentage if you calculate. Now, how do you calculate percentage? Same thing as you calculate percentage change. 212 number minus 1999 over 1999 and then times 100%. Okay, so that's how you calculate percentage change. Now, if you look at this M1, it has gone up by 352.3%. Okay, the increase in M2 and M3 are more modest, 172.4 and then 160.9%. Okay, now what does this mean for the economy? After you have calculated, you look at these numbers, right? What kind of story do they tell you about Singapore? Now, first of all, we answer part B. It asks us how much has the overall money supply changed between 1999 and 2012. Now, when you see a question like this, overall, okay, this word overall. Now, when we look at overall, it must be the widest definition of money, the most general definition of money. So it cannot be M1. Okay, we use M3. M3 includes all the 5 components inside the M classification of money. Okay, so we use M3, okay, as an indicator of overall. Overall also means total, or also means general. So we pick M3 as the most general definition of money. Okay, it has gone up by 160.9%. Okay, now, so what does this mean? When your money supply goes up over time, now this reflects a couple of things. This reflects a growing economy. Okay, especially when you look at M1, people are spending a lot more. And just now when you look at the chart on top of this, you see that demand deposits is actually rising very fast. Now, demand deposits are used to finance checks. Okay, so why are people using a lot more checks? Likely is they are making a lot more payments that has higher value. So this is reflecting that people are more wealthy and they are buying more expensive things that they could write checks. Okay, so we can safely say that there is a growing economy. Okay, now of course you can go and substantiate that by looking at Singapore GDP numbers. Okay, but when we look at these different M components, we can tell that people are more wealthy and they're spending more money, especially when you look at the demand deposits amount. It went up by quite a fair bit. Okay, now it can also mean that prices are rising. When prices are rising, people need more money, all right, to finance their usual purchase of things. Okay, so rising money supply can mean growing economy, which we can substantiate with the GDP numbers. It can also mean that prices are rising. Of course, we can check the CPI also. Okay, so this let us have another view of the economy aside from the indicators that you have studied. We studied GDP, we studied inflation rates. Okay, now so this money supply can substantiate what we have, what we are seeing. Okay, the percentage rates of growth or inflation rates. Okay, it can confirm what we have seen there. So when we look at the economy in general, it's a little bit like doctor diagnosing a patient. We can see how is the economy like using various indicators, and it gives you a different perspective of the economy. So money amounts and which components are changing can give us that picture. All right, another perspective other than your GDP and your inflation rates. Now, question three takes you through the money creation process, uh, or a small section of it, so that you can see the whole picture. Now, this is largely a repetition of what we have gone through in lecture. Okay, another example. Okay, now how is money created in the economy? Not just government printing money. Okay, money is actually created by accounts multiplication in the commercial banks when they lend out. Okay, now let's take a look at this example. Question 3, Mark was awarded a 5,000 scholarship in cash. So he deposited all $5,000 into his bank account in Bank A. Okay, now let's take a look at Bank A's balance sheet. Now, you have taken BA, okay, remember all your balance sheet theory, okay? Assets are recorded on the left, liabilities are on the right, okay? Now, once a $5,000 new deposit comes into the bank, it is recorded under the credit or liability side of the bank balance sheet, because these deposits are not the bank's deposit. These are the customer deposit and the banks owe it to them. Okay, so it's recorded under liabilities 5,000. Okay, now we go for accounting double entry. So one entry here, the other entry is here. The minute $5,000 come in, the bank's reserves goes up. Cash reserves go up by 5,000. Okay, so equalize on both sides. All right. Now, the bank will not just keep this $5,000 for nothing. Okay, the bank needs to make a living. Okay, earn some money to pay interest rates and things like that. Okay, so the bank will not sit around with this $5,000 for long. Now we assume that the banks lend out everything that it can legally. It can. Okay, maximum. Okay, and we know that the required reserve ratio is 20%. Now this is set by the central bank. Go take a look at the lecture or lecture notes. To recap what is required reserve ratio. Okay, so this required reserve ratio is set by the central bank. It's set at 20%. So commercial banks like Bank A must keep 20% of the deposit with it as cash reserves. Okay, cannot lend out the 20%. So let's take a look at the balance sheet when Bank A fulfills this criteria. So let's take a look at the balance sheet at the bottom. So Bank A, all right, has the $5,000 deposit from Mark, okay, earlier. Now, so out of this $5,000, this Bank A can lend out a maximum of 4,000, which is the remaining 80%. Okay, so as loans. So loans, 80% of 5,000 is $4,000. This reserves is compulsory and must be kept with the bank, cannot lend out, is $1,000. Okay, so this required reserve ratio is set by the central bank. So Bank A must keep $1,000 with it. So this $4,000 can be loaned out, okay, to somebody else, okay, and for the bank to make some money interest out of it. Okay. Now we assume that somebody took the $4,000 loan and opened up a new account with Bank B. Okay, the borrower's own bank. Okay, so for Bank B, they receive a new deposit of $4,000. Now this is the loan amount from Bank A. Okay, so it goes inside Bank B, all right, as new deposits of $4,000. So before Bank B lends out, straight away Bank B will have reserves of $4,000. Okay, now Bank B also starts to lend out. Okay, banks will generally try to lend out when they can to make some money. Okay, no point sitting on the cash. It doesn't change, right? So Bank B starts to lend out Again, you have the 20% required reserve ratio applied to all banks by the central bank. Okay, so Bank B must keep reserves of $800 with it. The rest of the 3,002 can be lent out. Okay, so and we assume that Bank B does. So Bank B lends out the remaining 3,002, and somebody will take this 3,002 and open up a new account with another bank. Okay, so you can see that a number of accounts are multiplying. Okay, from Bank A 5,000, then Bank B 4,000, and then someone will take this 3,002 and set up a new account. So there will be a new account of 3,002. So you can see that there's some kind of multiplying happening here. Now the question asks us, what is the size of the money multiplier? Okay, now based on your notes or the online lecture, you can see that there's a formula 1 over your triple R, which is your required reserve ratio, will give you your money multiplier. Now take note, when you calculate the money multiplier, please don't put 20 here. Okay, use the ratio 0.2 for 20%. Okay, now because it's a multiplier, you should not get a number that is less than 1. Then it becomes division. Okay, you should get a number like this, likely more than 1. Okay, sometimes there could be decimal points, but likely more than 1. So it allows it to multiply. Okay, it's a multiplier, so the number must be more than 1. Alright, so use the percentage like a ratio. In this case, 20% becomes 0.2. So after you calculate money multiplier, you know that there's some multiplying effect of 5 times. Okay, and then you use a formula, money multiplier times the initial excess reserves. Now what is this initial excess reserve? This is the amount that Bank A can loan out initially. Remember Bank A, look at your accounts on your notes or your tutorial question. Remember Bank A received a deposit of $5,000. It must keep $1,000 as cash reserves as mandated by the central bank. That means 20% due to the required reserve ratio. Okay, it can lend out the remaining 4,000. Alright, so this is the first time that the first amount that the bank can lend out in full. Alright, so we use initial excess reserves. Okay, the first time the banking system can lend out in full. So Bank A can lend out a full $4,000. We multiply it by the money multiplier 5 times. The new amount of new money created will be 20,000. Okay, reminder is money multiplier times the initial excess reserve, not the deposit. Okay, you must take out the triple R amount, which is 1,000, which Bank A cannot lend out as mandated by the central bank. Okay, now if you follow this process and if you look at the lecture or the online lecture again, you see that money is created only when commercial banks lend out money. Okay, when they lend out money, new accounts are created, and that's how money multiplies. Okay, now whatever that the banks cannot lend out does not multiply. So when we calculate, we use only initial excess reserve, not the deposit, because the bank cannot lend out all the deposit. It can only lend out that part less the triple R amount, which is $1,000. Okay, so you must take out the required reserve ratio first. Okay, so it's 4,000. You times, the system can create a maximum amount of $20,000. Now, how would a reduction of the required reserve ratio affect money creation? Now, this means that what if central bank reduce the required reserve ratio? So it could be telling the bank, no need to keep 20% of the deposit, just keep 10% will do. Now, when the banks need to keep less required reserves, it can lend out more. Okay, so let's take a look at, use the formula. Let's take a look. Now, if you use K, 1 over 0.1, okay, 1 over 0.1, you get 10 times. Your K becomes 10 times. K is the alphabet that we can use to denote your multiplier. So your multiplier becomes 10 times when we use the formula 1 over 0.1, 1 over triple R. Okay, so 1 over 0.1, you get 10 times. And when we use the formula 10 times your initial excess reserve, the money that you create goes up to $45,000. Okay, so take note, when your required reserve ratio goes down, your money multiplier goes up. Just now, when the required reserve ratio was set at 20%, your money multiplier was 5. Now, when the required reserve ratio is set at 10%, your money multiplier becomes 10. Okay, so when central bank allows commercial bank to lend more by telling them that you keep less required reserves, the money multiplier will go up and more new money will be created. Okay, $45,000 created when you have a 10% triple R. You contrast that with the earlier part of the question, 20%, you created 20,000. Okay, so you obviously created much more when the required reserve ratio goes down. Okay. Now, what we have done so far for this question, the earlier two parts, was to use the formula to calculate the money multiplying effect. All right, when commercial banks lend out, to find out how much new money is being created by using the formula money multiplier times the initial excess reserves. Right. So we have calculated based on a $5,000 deposit. Okay, when we set the required reserve ratio at 20%, we managed to create 20,000 earlier. When we reduce the required reserve ratio to 10%, we can create $45,000 of new money based on our $5,000 deposit. Okay, now this question is telling us that in real life you create less than that. Now why? Two reasons. Now the first is leakage. Now if you have seen the online lecture, okay, I use a picture of a bursting pipe to denote leakage. Now what is a leakage? As mentioned in the lecture, a leakage is when people borrow money but don't open up a new account. They take the money out of the system. Maybe they take it out as cash and spend it or something. Okay, so when they don't open up a new account, the lending process or the sequence is stopped. Okay, it ends then when the person takes the money out of the system. All right, so this is known as a leakage. All right, when they borrow money and they don't open up a new account. Okay, they take the money out of the system. Another reason is banks keep excess reserve. Now, what does this mean? That means the banks rather keep excess reserve than to lend out. So in layman's term, banks don't want to lend. Now, you have a problem when banks don't want to lend. So even when they can, they don't, your money creation capability will be very much reduced. Okay, because when people can't borrow, right, because banks don't lend out, when people don't borrow, you don't create that number of accounts or in terms of amount of loans. All right, you don't create that much because banks are not willing to lend out. Okay, so in that case, you won't be able to create the amounts that we calculated earlier. Okay, so these two factors. Okay, first is leakage, when people take the money out of the system, or when banks don't want to lend, your money creation capability will be very much reduced. Now for this question, it says, suppose the money supply in Singapore is this amount and the central bank or monetary authority of Singapore wants to increase it. What are the various ways of doing it? Now this is linking this topic to the next topic of monetary policy. Okay, how to increase this current stock of money. So we're jumping a little bit. Well, after you have seen the monetary policy lecture, come back to this question again, you will understand this better. To increase the stock of money, the central bank can use what is expansionary monetary policy. Okay, you learn that in the next chapter. Now today we did this, we understand what is the required reserve ratio in this chapter for money and banking. Okay, now when you reduce the required reserve ratio, you are telling the banks that they can lend out more. When they lend out more accounts are being created, money supply will go up. Okay, you have a couple more tools that you can use: decrease discount rate and purchase of bonds under open market operations. This one you will learn in the next chapter. Okay, so increasing the money stock, okay, is called expansionary monetary policy. Okay, so remember to take a look at your next chapter. You'll understand this better. Now let's take a look at our MCQs next. Okay. Now let's round up this tutorial with MCQ question. Uh, the first three are here. Now the first one, which of the following is the most liquid asset for individual? Now liquid means the easiest that you can exchange for goods and services without restriction. Okay, you can exchange for it almost immediately and with no restriction. So obviously it's cash. Okay, now all the other options, you must either sell or wait, okay, wait until your fixed deposit, the time is due, or you must wait to sell your apartment, do a lot of procedures before you get the value out. Okay, so the most liquid we define as liquid asset is when you can exchange for goods and services directly and the most quickly without delay. So it's actual cash. Okay. Now question 2 has to do with some banking products. Okay, when you buy something with credit card, you owe money. Alright, when you buy something with a debit card, money is taken out from your account directly. Now, therefore, when you go and apply for credit card, they want to see your income statement. Okay, because you're owing them, they want to make sure that you have the ability to pay back. Okay, debit card, you can only spend as much as you have. So usually when you apply for debit card, there's very little restriction. Okay, you cannot overspend. Alright, so the credit card you owe first, alright, and debit card, money taken out directly when you spend it. Okay. Now for question 3, the fact that prices are quoted in terms of money reflect money's role as what? Now remember that you have your 4 functions of money. So when prices are quoted in terms of money, it's actually measuring the value of things. Alright, so it's a form of measurement. So it's a unit of account that we're talking about. Alright, so in the same way as Celsius we measure temperature, kilometers we measure distance, we use money to measure value. So it's a unit of account. We are counting for the value of something. Alright, so that reflects money's role in this form. Okay. Now question 4, money is created when you do what? Now the answer is when you borrow money from the bank for whatever reason. Okay. Now the assumption is that when you borrow money from the bank, you open up a new account, and then based on the account, the bank can lend out some more. Okay. So this option is the only one that creates new money. Okay. So after going through the lecture and the tutorial, by now you should be familiar that money is created when banks lend out money and create new accounts. Okay, so in all the options, this is the only one whereby you do that. Okay, so the correct answer is E. Okay, now question 5, if reserve requirements are increased, that means your required reserve ratio goes up. That means the banks are telling, the central bank is telling the commercial banks, you keep more money with you, you cannot lend out so much. Alright, so therefore the money multiplier will become smaller, decrease. And when the money multiplier becomes smaller, the amount of money stock will decrease. Okay, money supply will decrease. Okay. Now the next few questions is based on this balance sheet of money bank. Okay. Now let's take a look at question 6. It says that if the RRR, the required reserve ratio, is set at 20%, that means this money bank must keep 20% of 2,000 with it. Okay, cannot lend out 20% of 2,000. Okay, so we take 20% of 2,000, money bank must keep $400 with it as cash reserves. Cannot lend out this $400. Okay, so 20% times your 2,000 deposit, money bank must keep $400 with it. But let's take a look at the balance sheet and see how much money bank is actually keeping. Money bank is actually keeping $500. That means it's keeping more than what it has to. Okay, so this extra amount is known as excess reserves. So it's keeping an excess of $100. Okay, it is required only to keep 400, but it's keeping 500. So the extra $100 is its excess reserves. Okay. Now for question 8, it asks us that with this 20% reserve requirement, maximum amount that the bank can lend out. Now just now we have already calculated 20% out of this deposit that the bank must keep as cash reserves, as required reserves. Okay, so it's 20% times 2,000. The bank must keep $400. Okay, with it. So the remainder $1,600 it can lend out. Okay, so it can lend out maximum of 1,006. Okay, now for question 9, we now change the required reserve ratio to 25%. Okay, and the amount of new deposit still 2,000. Now let's see what's the difference. Okay, now when you your required reserve ratio goes up to 25%. Now we already established earlier when the required reserve ratio goes up, the bank cannot lend out as much. So the money multiplying effect is lesser. So let's take a look at the formula. We take K, money multiplier, 1 over, again use ratio, 0.25 for 25%. You get 4 times. Just now we got 5 based on 20%. Now we got 4 times based on 25%. Okay, which is what we say. The more they got to keep as a required reserve, the money multiplying effect will go down. Okay, so now with a higher 25%, the money multiplier is now only 4. Now we complete the formula. New money created, we take 4 times the initial excess reserve, the amount that it can lend out. Now, so now it can maximum lend out 75% of the deposit, which is 1,005. Okay, so we take 0.75, the remainder that it can lend out times the $2,000 deposit is 1,005. So maximum that it can create now is 6,000. Okay, so calculate the money multiplier and then apply it to the new money created formula. Okay, so maximum that it can create is $6,000. Now for this question, it says that if banks choose to hold more excess reserves and lend out less, then what will happen? Now the answer will be money supply will fall. Now this is what we said earlier. When banks don't lend, they rather keep excess reserve and don't lend out. Now what happens is that when you lend out less, obviously less accounts are created, your money supply will fall. Okay? Now this is the end of our money and banking tutorial. Now as part of the OCR week task, please remember to watch the video on the next topic, which is on the monetary policy. Okay? And then there's an MCQ test on LMS on the monetary policy and money and banking. Now we are looking at your participation, so don't worry about the marks that you get. But we want you to provide feedback on the group blog on LMS. There'll be a question set for you to give you direction on what to write. Okay, so we want you to, after watching the videos, attempt the test and then provide the feedback on the group blog. Okay, have a nice OCR week.